had an executive lunchroom. Let's say it's a bank.
It's a high-end auto dealership.
It must be. Well, it could be. It could be. One of the center deans at one of the center talked about all these services that were provided when your car's being worked on. And I said, well, what kind of car is it? It was a Cadillac. I mean, you know, it's... Although when I'm at the Honda place, they do have a computer lab, so I can do my coursework over there. But here they were providing a buffet and everything else. They said, oh my God, what is this? Auto dealership has an executive lunchroom available to employees above a certain level. The controller informs James that she can eat there anytime. Let's say it's a bank. I remember at the Northern Trust, when I worked at Northern Trust, there was an executive lunchroom for upper level executives that had the fancy free meals, and it had the wood paneling over the LaSalle building. So let's say they say you can go there and eat free at any time.
I think it will be a violation, but I think it's pretty petty if it is.
Yeah, I was going to say it's kind of like, you know, splitting hairs. I mean, it's...
Well, I think it would be better if she went there all the time and by herself. I think it would look bad. Now let's say again that Barry's the controller and he and I are meeting on a matter. And then he said at lunchtime, why don't we discuss this further at the executive dining room? So there I think it'd be fine because we're discussing actually business at the same time, you know, we're enjoying the lunch. You're right. I mean, I'm hoping she couldn't be bought for a $10 lunch.
Well, and she's not an executive, so if no one else could eat in there but executives, and then you let her, I mean, she's an auditor, I mean,
she's big
seems like you're
special
sucking.
privileges.
Yeah, so it doesn't look good again, not necessarily a distinct violation, but James is also invited to and attends the company's annual Christmas party. When presents are handed out, she is surprised to find her name included, and the present has a value of approximately $200.
Again, I guess.
Now that's going to be a violation because of the amount. What would you recommend she do? Let's say it's you. Amanda, it's you at the party. Everyone's exuberant for the holiday season. They're all smiling. They've had a lot of cocktails and enjoying refreshments. What basically should you do?
Not accept it.
Should you not accept it right at the time?
No, you would accept it and then you would give it back.
That's right. That's right. I would agree with that too. Yeah, accept it at the time because you don't want to put, you know, a downer on the party. But you're right, the next day when everyone's recovered and you're out there at the audit again, return it saying, well, thank you so much. I really appreciate you having considered me as one of the family, but I just can't accept this.
What's the amount? You said something because it was 200. What is acceptable?
Well, the thing that would just, to me personally, now here at DeVry, there's, I think the amount is like $50 or something, or 75. I'd like $25. Now, if they gave me, let's say, a paperweight with the emblem of the company that was worth $25, I think that's fine.
Right.
You know,
so,
but I believe in keeping it low. Keeping it low, $25. I wouldn't go anything more than that.
Oh, it's a present. I'm sorry. I just automatically assumed it was cash.
No, but it could be a kit with Chivas Regal Scotch with a bunch of glasses or something for $200. I mean, did you ever run into anything like this in your experience? Yeah, a paperweight or something, or some kind of an emblem with the firm or something, fine. But I would be unhappy with anything over $25. Or what if it's a $25, let's say, book of coupons for McDonald's? You know, that bothers me too because it's not like a paperweight with the client emblem on it. It's something that I can use, or a $25 gift certificate at AMC theaters. That bothers me still too, even though it's only $25.
What if it's like a nice winter coat with the company emblem on it? You know.
Again, there too. I mean, because of the garment is probably, well, that's interesting. Or what if it's a T-shirt like you have on? That could be a $25 shirt. It's probably more than that, but yeah, with the emblem. What do you think?
You could keep it, but not wear it. I mean, I don't know. Like my company, we can't wear any other company's I mean, I could do it at home, I guess, but I can't come into the office
Right.
wearing, you know, I work for a mechanical contractor, so I can't wear like a train, you know.
Okay.
You can't do anything like that. I'll probably give it back.
If I accepted something like that shirt, I wouldn't want to wear it at any function where I might be seen by members of the firm.
Right,
You know, because it almost implies that you're an employee.
right.
You know, that's the other issue. Interesting, though. Okay, well, I've enjoyed Marie Jane's for many years. And I think there's one more, then we'll go to the board here. You're saying, Bill, it's already 3 o'clock. Don't worry about it.
All those were real 101 then?
Yeah, all 101 without definite answers per se, and they kind of disturbed us a little bit because of appearance purposes. Okay, let's look at 27. I'm trying to remember which one that was. Oh, yeah, oh, yes. This one has also been on the book for a while. This, again, is a little bit higher level. 4-27. By the way, the instructions to me. The answers to these questions are more judgmental than most others in the chapter. They may in some cases be a violation of the spirit of the code. If the CPA is acting in a certain manner, they may not be in violation if the CPA is acting in a different manner. Changing the facts throughout the discussion may increase the value. So let's look at this, and then we'll shift over to the legal chapter, where I've summarized a lot of it on the board, except for the criminal stuff in the 1934 SEC Act. Okay, we're on page 110. Contel CPA, oh yes, this is it, advertises in the local paper that his firm does the audit of 14 of the 36 largest community banks in the state. Also states the average audit fee as a percentage of total assets for the bank he audits is lower than any other CPA firms in the state.
502.
That's his 502. Now, what do you think? There's 2 separate parts here.
Doesn't that violate Sarbanes-Oxley because they're not supposed to advertise, like, if it's misleading or?
Well, false, misleading, or deceptive, and that's I think the second part. Let me comment. You have to be able to prove what you're saying. Now, the fact that you audit 14 of the 36 largest community banks in the state, that I think is okay because that you could prove. And if you didn't do 14 of the largest 36, then of course it's false. But look at the other part. The average audit fee as a percentage of total assets for the bank you audit is lower than any other CPA firms in the state. How could you prove that? You would not have access to that information. So I agree with Lena, at least on the second allegation, it's a violation because you can't prove it. The first part, maybe you can. Any other ideas on that?
Which rule was that?
502.
Isn't that kind of a contingency fee?
No,
No,
it's
okay.
just strictly advertising. Okay, number 2. And this one I don't have an answer to, so you'll have to help me. Davis CPA sets up a small loan company specializing in loans to business executives and small companies. He does not spend much time in the business because he's involved with the CPA practice. No employees of a CPA firm are involved in the small loan company.
505.
I don't think so. That's about the name of a company. This is a CPA firm who basically has another outside business that he doesn't really do much with. I think it's probably a 101 issue, but is there a violation?
I don't think so.
I don't think so either. I mean, let's say, for example, I'm a CPA, and I also have a home improvement business on the side. I occasionally do something, but primarily my employees do kitchen remodeling, bathrooms, roofing. You know, it's completely unrelated to the CPA business. Anyone have a different view? Because I don't have an answer for this part of the next one.
Yeah, I mean, it didn't say that, he was giving his, his client's special privileges at the.
Right, it wasn't like the other
Right.
one where he sent his audit clients to the
Right.
insurance agency. I think I would agree that with Barry on that. Okay, the next one I don't have a response for either because they're not in the new edition. Elbert owns a material amount of stock in a mutual fund investment company. It's a mutual fund, remember, which in turn owns stock in Elbert's largest audit client. Reading the management company's most recent financial report, Elbert is surprised to learn that the company's ownership in his client has increased dramatically.
101.
It's 101, but is there really a violation here? Do you ever notice anyone have mutual fund investments here? Okay, I have a couple mutual funds. I mean, I don't even know all the stocks that are in there. I get a notice every now and then. I think of the 10 most widely owned stocks in the mutual fund, but I'm sure it has stocks in other companies as well. Also, it said increased dramatically. It could be that the stock was 1% of their holdings, now it's 2%.
So what's the special thing with mutual funds?
Mutual funds basically hold a whole bunch of stocks. You know, as they said, if you have a mutual fund and you can look in there and they'll give the 10 most frequently owned stocks in that fund. Usually they'll have a tech stock in there. They might have Walmart. One of the ones I have stock in, there's Walmart is one of the stocks they own. So a mutual fund has a whole variety of different stocks in their portfolio. And so, and it said increased dramatically, but the largest stock ownership could be maybe less than 5% of the total holdings of the fund. So I really don't see a violation here.
So if I was a partner, so basically because the company wasn't invested directly, is that what?
Well, it could be because you could say it's not a direct investment. A mutual fund has investments in stocks of many companies. Now, some mutual funds are restricted to one industry, like the tech industry. And the increase dramatically, usually there's no one company stock in the mutual fund that represents more than 5% of the total holdings. But again, there's no definite answer here per se. Okay, number 4, Abel owns a substantial limited partnership interest in an apartment building. Frederick Marshall is 100% owner in Marshall Marine. Marshall also has an interest in the limited partnership as Abel. Abel does the audit of Marshall Marine. So basically we have a CPA who audits a client. The CPA is a limited partner in an apartment complex. And the audit client is also a limited partner in the apartment complex.
101.
It's 101, but I don't see a violation again. First of all, many times when you're a limited partner in like a real estate partnership, you don't even know who the other limited partners are because you're strictly investors. So it has nothing to do basically with the performance of Marshall Marine. So I don't see a violation here. So independence would be considered to be impaired if Abel and the client or an officer of the client had a joint closely held investment that was material. This is difficult because it's possible Abel and Marshall are unaware of the joint closely held investment, since in many cases the limited partners do not know of the other investors in a limited partnership. But notice they have a little cop out there. They said if it was material, it could have an influence. Limited partners normally do not know who other limited partners are. They know who the general partner is, but they don't know who the other investors are. But I guess I got to open up a little bit that if it were a limited number of limited partners, because it's not like a mutual fund, then there could be an impact. What's the best way, by the way, to avoid this problem? If you, let's say you found out about it. Oh, I own that apartment complex out in Wheaton. Oh, that's funny. Our firm has a limited partnership interest in that as well.
Got it.
Sure, yeah, just sell it off. So you can always do that to avoid the problem. Baker's CPA approaches a new audit client and tells the president he has an idea that could result in a substantial tax refund in the prior year's tax return by application of a technical provision of the tax law the client had overlooked. The fee will be 50% of the tax refund after it's been resolved by the IRS. The client agrees.
No violation.
Yeah, this is the one that bothers me. It's the 302. The official answer says no violation because of that language that in tax matters or determined on the basis of governmental agencies. I don't like it. It may not be a violation. I don't think that's appropriate in tax matters, but I agree with Amanda, no violation. That one sentence that was in Rule 302, if determined based on the results of judicial proceedings and the findings of government agencies. And number 6, if you read it, here's a female CPA. She does a whole bunch of work. Now, it says here she does work for a Gilligan Construction Company. She does audit, tax return, bookkeeping, etc. Obviously, this is not a publicly traded company, or she couldn't do all those things. She has to make, basically, it looks like the owner of the company and she are very close friends. They often meet for drinks. And she says, the owner of the company says, I have 3 business partners. My banker, the government, and my CPA, but my CPA, Finney's the only one who's on my side. Let me just, well, what do you think about this relationship?
First of all, she's auditing her own work.
Yeah, but it's privately held, so that is permissible.
Okay.
I think independence is impaired.
Yeah, I mean, how, if this is your best friend, or this is somebody you go out drinking with every Friday, or maybe they go clubbing or something.
Yeah.
I mean, how can you be objective?
You can't. And
You
it's
can't,
always
exactly.
going to be favorable towards your friend and their business.
Exactly, and so that's why you need to always maintain some distance between yourself and your clients.
But no violation.
No violation, but, oh, you're not going. We haven't even gotten to the next
Yes,
chapter.
I will do that today.
I'm sorry?
We haven't even gotten to the next chapter. No, you can have that.
Oh, okay. Thank you.
Yeah, I made copies of the buddy sheet for everyone, so I'll pick one up. At the undergraduate level, I was afraid to pass it out, but at the graduate level, I think it's okay. Yes, never get too close. All right, now you'll say, Bill, we're falling behind schedule. Now we're doing fine. Back right now, look, Lena, can you give us, is it raining or what? Look outside.
Yeah, it's.
Aww, I was gonna go to the Taste of Bolingbrook.
Well, maybe it'll be over later. If it pours down, plus this may break the heat, so we don't have the strong heat later. All right, now on the board, I've summarized almost all of Chapter 5. We have, this is the legal chapter, so I thought this was appropriate. This could be, oh yeah, camera shots are highly encouraged, of course, as always. The only thing that's not up here on the board is, I didn't talk about the criminal actions. Now, they have the Arthur Anderson case in here. The other criminal case used to be U.S. versus Simon from 1969, one of President Nixon's buddies. The other, though, is the 1934 Securities Exchange Act. Let's talk about that briefly, then we'll look on the board, and we'll go right to homework. The 1934 Securities Exchange Act, what is the most typical section of that act and the most common rule under that act? 1934 Securities Exchange Act. Familiar with it here? 34 Act? All right, well, it's part of some other courses that maybe you didn't take. Management 520, for example, is not a course that MAFM people would be taking, and it's covered in depth in there. Basically, it deals with schemes, devices, or artifices to defraud. Section 10B and Rule 10B-5. Scheme, device, or artifice, I love the word artifice, to defraud. Notice that requires intent. Fraud requires intent. Now, on the board, and then we're going to go right to homework problems. In a tort action, in a suit by the client could be on one of three bases of recovery. Negligence, simple negligence. That's failure to follow generally accepted generally accepted auditing standards. Or failure to act as a reasonably prudent person. Gross negligence, or sometimes called constructive fraud. There's no intent to deceive, but your conduct is so outrageous. Or look at the next word, flagrant. It's not fragrant, that would be smelling flowers. Flagrant. As to border on fraud. And then fraud itself. Fraud itself has 5 subcategories. The first one is scienter. That's from the old Latin scio, scire, meaning to know. Knowledge. 2, intent to deceive. 3, probably I should have put a material misrepresentation. 4, reliance on the misrepresentation. Notice if the auditor has a misrepresentation, but the injured party knows the true state of affairs, there's no reliance. And then a loss is suffered as a result thereof. Notice in red, third parties in a lawsuit can only recover on the basis of either gross negligence or fraud. Third parties cannot recover on the basis of simple negligence. Defenses to negligence, I wasn't negligent. You were contributory negligent. This may apply especially when an officer of the company is part of the action. No loss was sustained and there was no duty that was owed. The no duty owed would be for the simple negligence for third parties. Contract theory. Client sues for breach of contract. You breached the contract that we entered into to perform services on behalf of the performance of the audit. Third parties can only sue on contract theory if they were specifically named in the contract. Remember, for breach of contract, you have to have privity, which means you normally have to be a signator to the contract. But if there's a third-party beneficiary who is named in the contract and the contract is breached, that third party could then sue for breach of contract. What's an example? Let's say the contract between the auditor and the company says that the purpose of the contract is to establish whether or not a loan should be issued by Fifth Third Bank. Fifth Third Bank is specifically named in the contract. If the contract is breached, Fifth Third Bank can then sue the auditor. Now, what if the contract said between the auditor and the client said, in order to obtain a loan from a banking institution, and it did not specifically name any bank, then no banks are third-party beneficiaries of the contract, so they can't sue. Defenses, we didn't have any duty, there was no privity, there's no breach, there's no damages. Now that's the chapter in a nutshell. Let's look at the problems in the chapter. We may not get to those ones in Chapter 11, but like I said, we covered that in the online discussion, and I told you just to skim over those so you won't have to include them in the Dropbox. But let's go into Chapter 5, and we'll wrap up our, boy, the time goes so quickly here. My gosh. Okay, 5-19, 20, 21, 22, 23. Oh, there's a lot of them. Good, Bill. Thank you. Okay, 5-19, page 135. We have a medium-sized CPA firm. Basically, they're well-trained. The CPA did plan the audit, supervised, and reviewed the work. This is good. Significant part of the audit entailed verifying the physical count, cost, and summarization of inventory. It was highly significant, and it was pledged as collateral for a loan to First City National. In reviewing the inventory count procedures, the CPA told the president she believed the method of counting inventory at different locations on different days was highly undesirable. There's a famous fraud, by the way, involving a friend of Lyndon Johnson, ex-president, involving salad oil, where some tanks of salad oil throughout the state of Texas were supposedly filled, and the tanks were inspected on different days. It turns out that the salad oil only filled the tanks at one location, because after that location was investigated, then under cover of darkness, the salad oil was drained into tanker trucks from that location to go to the next location. So something like that happened here. Okay, it turns out here the president said, no, it's impractical. We have personnel shortages, etc. After considerable discussion, Yost agreed to permit this practice of counting on different days at different locations if the president would sign a statement that no other method was practical. CPA firm had at least one person at each site to audit the inventory count and actual count. There were 40 locations. 18 months later, the worst happened. Turned out that they overstated inventory, and that obsolete inventory was covered up by management. The misstatement occurred by physically transporting inventory at night to other locations that had already been counted to the next location to be counted. Both the client, and it was their president engaged in the fraud, and the First City National sues the auditor. Okay, a variety of questions here. Let me get to this one. This is 5-19.
I think the text said that there's a lot of litigation.
Well, there could be here, but what kills me...
No, I meant like in the accounting business industry in general.
I would hope that it would not be that extensive, but I've never kept an actual count. I would hope it wasn't.
Okay.
Although usually when somebody suffers a loss, they want to get reimbursed by somebody. What defense should the CPA use in the suit by the client? Well, it was the client's president who was the perpetrator of the fraud. So it's contributory negligence, at least. I mean, if you're a perpetrator of the fraud, how can you sue the CPA when you're the one responsible for engaging in the fraudulent conduct? So the client was guilty of fraud, was guilty of contributory negligence, and therefore cannot recover against the CPA. But what defense should the CPA use in the suit by First City National? What's the CPA going to argue with this with First City National? Now, on contract theory, they would argue lack of privity of contract, because First City National, let's say, was not a signatory to the contract.
Were they?
No, they didn't sign the contract. The contract was signed by the CPA and by the company, the client. But what about in a tort action? Remember, in a tort action, there has to be gross negligence or fraud. Do you think the CPA was guilty of gross negligence or fraud? No. No. She covered herself by getting that particular document in writing by the president. So is Yost likely to be successful in her defense against the bank?
Yeah.
Yes. I mean, the bank's the one who gets screwed here. Let's be honest. The bank did nothing wrong, and the bank cannot recover against the CPA firm because they're not a third-party beneficiary of the contract, and there was no gross negligence or fraud. Now, they have a cause of action against the company. You know, they could foreclose on property or something. Would the results have been significantly different if the suit was brought under the 1934 Securities Exchange Act? No, because the 34 Securities Exchange Act requires intent to defraud, and the CPA here was an innocent party. Anyone see this one? Any other ideas?
Does Yost,
Go ahead, Barry.
Does Yost have any legal grounds to sue Stewart?
Interesting perspective. What if the CPA here, Yost, her reputation was severely injured and she lost clients? Then maybe yes. Now, that salad oil scandal problem, oh, I remember the guy's name. It was a friend of Lyndon Johnson, Billy Sol Estes. Well, you know, it's a southern name, Billy Sol, has, you know, the three names. I don't know if this is based on that, but that was the one with the salad oil traveling by night from one location to another.
Would it matter if she, in her audit, she has to put something with the inventory, how they actually counted their inventory?
Now, she had this statement from the president. What if she hadn't gotten that particular statement from the president?
Then she.
Well, you know, that's a trickier case. It would be simple negligence, but that's not enough for third parties.